All right, let's get right into it. Looking at Applied Digital Corp, ticker APLD, the market is live and the stock is trading at $28.42, down about 0.5% or 15 cents on the day as of 10:10 a.m. Eastern Time. The day's range has been fairly tight with a low of $28.10 and a high so far of $29.08 on volume that's already hitting about 2.6 million shares. Now, the immediate expectation when most people, especially those doing self-investing, look at APLD is that they've found a hidden backdoor play on the artificial intelligence build-out. They see data centers and HPC, and they immediately think this is a way to get NVIDIA stock-style returns without paying the NVIDIA stock premium. The common belief is that this is a picks and shovels company, and in an AI gold rush, that's a can't-lose spot to be in. But here is the critical reality that the daily chart watchers are missing. This is not a software story. This is a brutal, capital-intensive, high-debt construction and energy story. The entire bull case and the entire bear case hinges on something far less glamorous than AI. It hinges on construction timelines, tenant credit risk, and the cost of debt. We just saw news 2 days ago, on November 10th, that Applied Digital is planning a massive $2.35 billion senior secured note offering. That isn't a small detail. That is the story. The expectation is AI growth. The reality is that this growth is fueled by a mountain of new debt, and S&P just assigned that debt a B+ rating, which is deep in speculative territory. Let's break down this recent price movement. The stock has been incredibly volatile this year, swinging from a low of $3.31 to a high of $40.20. That's not the chart of a stable infrastructure company, it's the chart of a high-stakes narrative stock. This kind of action is a magnet for traders on platforms like the Robinhood app or SoFi Invest, who are looking for that explosive move. But this volatility is a double-edged sword. We saw it just last week. Around November 7th, the stock had a massive 10% intraday pullback before recovering. Why? Not because of any company-specific news, but simply because of wavering confidence in the AI sector's valuation and some bearish consumer confidence reports. When your stock swings 10% on sector sentiment, it tells you that its valuation is not anchored by fundamentals, like earnings, which are negative, by the way, at a loss of $1.14 per share, but by pure speculation. This is a world away from the kind of stability you'd look for when building a long-term position in your Fidelity or individual brokerage account. The recent news flow is what really separates the expectation from the reality. The bulls are cheering the announcement from October 22nd, and rightfully so. The company signed an estimated $5 billion 15-year lease agreement for 200 megawatts with a U.S. investment-grade hyperscaler. This is exactly what you want to see. It's a sign of validation. It brings their total leased capacity in North Dakota to 600 megawatts. This is the narrative that supports the strong buy analyst. This is what investors who are investing online are betting on. They believe this is the first of many such deals. But now, the reality check. Let's look at that $2.35 billion debt offering. That money is specifically to fund the construction of the next data centers, the ELN-02 and ELN-03 facilities. This is the hamster wheel of a capital-intensive business. You have to spend billions first, taking on massive debt, in the hope of signing tenants later. And who are the tenants? One of their other major tenants is CoreWeave. While a fast-growing company, S&P Global noted in their new rating that this represents a significant tenant concentration with a speculative-grade counterparty. This isn't like leasing an office building to Apple stock or Microsoft. The risk profile is substantially higher. If CoreWeave stumbles, or if the AI compute demand landscape shifts, APLD is the one left with a very expensive, very specialized building in North Dakota, financed with very expensive debt. This is the kind of deep operational risk that a simple Robinhood stock trading interface doesn't explain. This is where a more serious investment analysis is required. When you're using a platform like Fidelity Brokerage or Interactive Brokers, you have access to the balance sheets. And APLD's balance sheet is, well, it's a construction company's balance sheet. As of the most recent filings, we see total assets ballooning, but it's almost all in property, plant, and equipment. That's the data centers. On the other side of the ledger, total liabilities are exploding to match. Long-term debt is jumping from $79 million in May 2024 to $677 million in May 2025, and that's before this new $2.35 billion offering. This is the definition of an all-in bet. The company is not growing organically. It is leveraging itself to the hilt to build as fast as possible. This is a high-stakes race. If they win, if they get all these facilities built and leased to high-quality tenants before their debt load crushes them, the stock will be a massive success. If there are construction delays, cost overruns, or a major tenant pulls out, the downside is just as extreme. Let's talk about the institutional ownership, because this is where the story gets even more interesting. You'd think the big conservative funds would stay away, but the 13F filings show 512 institutional owners. Vanguard and BlackRock are in the top 3, which is typical for index funds. But the largest shareholder, with over 8% of the company, is Hood River Capital Management, a small-cap growth fund. And very interestingly, NVIDIA Corp itself is listed as a top 5 shareholder, holding nearly 3% of the company. This is a massive expectation-setting detail. The fact that NVIDIA, the kingmaker of the entire AI space, has a direct holding is a massive endorsement. It's the kind of fact that gets passed around on SoFi investing forums and builds the bull case. The reality, it's a strategic investment for NVIDIA, likely to ensure its partners in the ecosystem have the capital to build the infrastructure needed to house NVIDIA's own GPUs. It's a smart, synergistic move for NVIDIA, but it doesn't fundamentally de-risk APLD's massive construction and debt problems. It's a vote of confidence, but it's not a blank check or a guarantee. So, for those who are just now learning about the company, what is the business? Applied Digital started its life as Applied Blockchain, a crypto mining company. This is a critical piece of its history. It's why the stock has such a volatile, retail-driven shareholder base. They executed a very smart pivot away from the volatile crypto mining world and into the high-performance compute and AI data center space. Their business model is to build these next-generation facilities specifically designed for the massive power and liquid cooling requirements of modern AI chips and then lease them out on long-term contracts. The expectation is that this is a stable, recurring revenue business, like a landlord. The reality, as we've discussed, is that they are a highly specialized builder first and a landlord second. Their product is speed to market and the ability to handle complex power and cooling designs that legacy data centers can't. Looking forward, the future of APLD is a tale of 2 very different scenarios. The bull case, the one that excites the self-investing crowd, is that the AI demand for compute is so insatiable that anyone who can build a data center, especially one optimized for liquid cooling, will be flooded with investment-grade tenants. In that scenario, APLD successfully builds out its North Dakota campuses, signs long-term leases with the likes of Amazon, Google, and Microsoft, the hyperscalers, and uses that predictable cash flow to pay down its debt and become a cash flow machine. The stock would, in that case, be worth far more than $28.42. The analyst target of $42.50 would look conservative. This is the future that traders using the SoFi trading platform or buying Robinhood fractional shares are dreaming of. Now, the bear case. The reality is that execution risk is a polite term